Is the athleisure giant Lululemon about to hit a rough patch, or is this just a bump in the road? Today we're breaking down why yet another Wall Street expert is turning bearish on Lululemon, and what it could mean for your portfolio. By the end of this video, you'll know what's really going on behind those yoga pants, what the latest analyst downgrade signals, and what to keep an eye on if you're thinking about buying, holding, or selling Lululemon stock. Let's dive right in. Lululemon has been a Wall Street darling for years. The company practically defined the athleisure category, turning stretchy pants into a multi-billion-dollar fashion statement. But now, some of the market's biggest bulls are quietly exiting the stage. Another top analyst has just downgraded Lululemon, pointing to a troubling trend. The company is ramping up discounts on its merchandise. Why does this matter? In simple terms, markdowns are a red flag. When a brand known for premium pricing starts slashing prices, it usually means demand isn't as hot as it used to be. Think about it. Lululemon built its reputation on selling $100 yoga pants with almost no discounts. If you're seeing more sales racks, it could signal that inventory is piling up and the company needs to move product fast. Let's add some context. Just a year or two ago, Lululemon could barely keep its shelves stocked. Post-pandemic, demand for comfortable work-from-home clothing soared. The stock reflected that story, shooting up over 150% from early 2020 to mid-2023. Investors loved Lululemon's high margins and loyal customer base. The brand was expanding internationally, launching new product lines, even dabbling in tech with its Mirror fitness device. But fast forward to today, and the narrative is shifting. The latest earnings report showed a jump in so-called marked-down merchandise, industry speak for items the company couldn't sell at full price. That's a sharp contrast to Lululemon's usual approach. Analysts are zeroing in on this metric because it's often a canary in the coal mine. When markdowns go up, profits go down. And for a company like Lululemon, which depends on its premium image, frequent sales can also hurt the brand longer term. Here's what the analyst downgrade really means. Wall Street is getting nervous that Lululemon's best days, at least in the short term, might be behind it. The analyst behind the latest downgrade says a turnaround could take at least 6 months, if not longer. That's a big deal. It suggests that even if Lululemon can right the ship, investors shouldn't expect a quick fix. So, what's driving this slowdown? There isn't a single culprit, but there are a few key factors at play. First, consumer spending is cooling down after several years of stimulus-fueled growth. Customers are getting more price sensitive, especially for high-end workout gear. Inflation and economic uncertainty are making shoppers think twice before dropping $100 on leggings. Second, competition is heating up. Brands like Nike, Adidas, and upstarts such as Alo Yoga and Gymshark are all fighting for a slice of the athleisure pie. Even traditional retailers like Gap and Target have launched their own activewear lines at lower price points. Lululemon is no longer the only game in town. That puts pressure on their pricing power and may force more markdowns just to keep up. Let's put some numbers on this. Lululemon's gross margin, a key measure of profitability, has been under pressure. In their most recent quarter, it slipped compared to last year, largely due to higher promotions and inventory costs. Meanwhile, inventory levels have crept up by double digits, suggesting that the company may have overestimated demand. That's a classic recipe for more discounts and thinner profits. Now, does this mean Lululemon is doomed? Not necessarily. The company still has a devoted following, strong brand equity, and international growth opportunities, but the road ahead looks bumpier than before. Investors need to weigh whether the current share price fairly reflects these new risks. Historically, Lululemon has bounced back from challenges. Remember when they faced backlash over product quality and controversial comments from leadership a decade ago? The company retooled, invested in innovation, and came back stronger. But this time, the headwinds are different. The broader market environment is tougher, and the competitive landscape is far more crowded. So, what should you watch for next? Keep an eye on the next quarterly earnings report. Look for updates on inventory levels, margin trends, and, most importantly, whether markdowns are still rising. If the company manages to clear out excess inventory and stabilize profits, sentiment could shift quickly. On the flip side, if markdowns keep climbing, the stock could face more pressure. It's also worth noting that Wall Street analysts can be a bit like weather forecasters. They react to trends, but they're not always right. Sometimes a wave of downgrades can create buying opportunities for patient investors, especially if the market overreacts. But it pays to be cautious when a company's core brand promise, premium, full-price merchandise, is under threat. Here's the bottom line. Lululemon's latest analyst downgrade isn't just about one bad quarter. It's a signal that the company faces real challenges, both internally and externally. Whether this is a temporary stumble or the start of a bigger shift remains to be seen. If you found this breakdown helpful, make sure to hit that like button, leave a comment with your thoughts on Lululemon's future, and subscribe for more clear, no-nonsense financial analysis. And as always, remember, in investing, it's the details that matter. What happens next for Lululemon could say a lot about how luxury brands adapt in a changing world. Stay tuned.